Good morning, students. I am Sanjay Kambe, Assistant Professor in Department of Accountancy at Dhananjay Rao Gadge College of Commerce, Satara. In our previous lecture, we are studied the unit number first, that is Introduction to Management Accounting. In our today's lecture, we are start our next unit number second, Analysis of Financial Statements. In this unit, we have to study the meaning and components of financial statements. Here, financial statement analysis meaning. Financial statement analysis is an analysis which highlights the important relationship in the financial statements. It focuses on evaluation of past operations as revealed by the analysis of basic statements. Financial statement analysis embraces the methods used in assessing and interpreting the results of past performance and current financial position as they relate to particular factors of interest in investment decisions. Financial statement analysis is an important mean of assessing past performance and in forecasting and planning future performance. Financial statement analysis is a systematic and specialized arrangement of information for the purpose of its interpretation. It means that the profit and loss account and balance sheet does not convey much meaning. It therefore becomes necessary to study certain figures in relation to some other relevant figures to arrive at certain conclusion. For example, if we are given the figures of only gross profit earned by a business firm, we cannot say whether the gross profit is heavy, reasonable, or insufficient. For this purpose, we must take into consideration the figure of sales. Thus, the gross profit is required to be studied in relation to the sales to decide the percentage of the gross profit to sales. On the basis of this percentage, we can conclude that whether the gross profit earned by firm is reasonable or sufficient or heavy. Thus, the relationship between the two figures expressed mathematically is called a ratio analysis or financial statement analysis. Here, definitions of financial statement analysis. First, financial statement analysis is an information processing system designed to provide data for decision making model such as the portfolio selection model, bank lending decision model, and corporate financial management model. It means that the financial statement analysis is useful for making decisions in various aspects of the business such as portfolio selection model, bank lending decision model, and corporate financial management model. Second, financial statements analysis is largely a study of relationship among the various financial factors in a business as disclosed by a single set of statements and a study of the trends of these factors as shown in series of statements. It means that it means that ratio is one mathematically number expressed in term of another. However, the two figures must be interrelated. If the two figures are not at all connected with each other, their ratio will be serve no useful for the business organization. Next, components of financial statement analysis. The first step towards improving financial literacy is to conduct a financial analysis of your business or of any business. A proper analysis consists of five key areas, each containing its own set of data points and ratios. First point in components: revenue. Revenues are probably a business main source of cash. The quantity and quality and timing of revenue can determine long-term success of concern. Revenue is the main source of business. It determines the long-term success of the business. In revenue, there are also three components: revenue growth, revenue concentration, and a revenue per employee. First, revenue growth. Revenue growth is calculated according to the formula as given in your presentation. Current revenue minus previous revenue divided by previous revenue. When calculating revenue growth, do not include one-time revenue which can distort to business are taken into consideration. One-time revenue should not be taken into consideration. It collapses the analysis of the business. Second, revenue concentration. Revenue concentration is calculated as a formula uh, given in your presentation. Revenue from customer divided by total revenue. If a single customer generate a high percentage of your revenue, you could face financial difficulty if that customer stops buying. No client should represent more than 10% of your total revenue. If a single customer generates a high percentage of revenue for your business, you could not face financial difficulty because the customer is stop buying. Then you face so many difficulties regarding revenue, and the customer is generate more than 10% total revenue of the business. Revenue per employee. Revenue per employee is calculated according to the formula revenue divided by average number of employees. This ratio measures business productivity. The higher the ratio, the better the business condition. Many highly successful companies achieve over 1 million dinner in annual revenue per employee. Second component, profit. If we can't produce quality profits consistently, the business may not survive in the long run. If the business does not earn a consistent profit, then the business does not survive in the long run. In profit, there are also three components: gross profit margin, operating profit margin, and net profit margin. Here, gross profit margin is calculated revenue minus cost of goods sold divided by revenue. A healthy gross profit margin allows you to absorb shocks to revenue or cost of goods sold without losing the ability to pay for ongoing expenses. It means that the gross profit is better, then the business does not lose the ability to pay for ongoing expenses. Means day to day expenses is paid by uh, business when the gross profit is high or healthy. Second component, operating profit margin. Operating profit margin is calculated that as per the formula revenue minus cost of goods sold minus operating expenses. Revenue means income minus cost of goods sold minus operating expenses, those expenses which are related to business, divided by revenues. Yeah. Operating expenses does not include interest or taxes. This determines the company's ability to make a profit regardless of how you finance operations, debt or equity. The higher, the better the condition of the business, or better the profitability position of the business. Net profit margin, calculated with the help of the formula revenue minus cost of goods sold minus operating expenses minus all other expenses divided by revenue. This is what remains for reinvestment into your business and for distribution to owners in the form of dividends. Here, net profit available for the equity shareholders and some net profit are reinvested in the same business, and remaining amount is distributed, or remaining net profit is distributed among the shareholders and owners. Third component, operational efficiency. Operational efficiency means it measures how well using the company's resources. A lack of operational efficiency leads of the business. Operational efficiency leads to uh, operational efficiency leads to smaller profit and weak growth. If the operational efficiency is weak, if the operational efficiency is high, then the business concern is earn uh, heavy profit in the business organization. In this component, there are also a two parts: accounts receivable turnover and inventory turnover. Account receivable turnover is calculated as per net credit sales divided by average accounts receivable. This measures how efficiently the business manage the credit extended to customers. A higher number means your company or company is managing credit well. A lower number is a uh, warning sign to company should improve how you collect from customers. Inventory turnover, cost of goods sold divided by average inventory. This measures how efficiently manage inventory of the company or organization. A higher number is a good sign. A lower number means the business concern either are not selling well or are producing too much for your current for organizational current level of sales. It means that if the inventory turnover ratio is high, it is a good sign for the concern. But if the inventory turnover ratio is lower, then it is not good sign for the organization. The company will not sell well its product in the market, and it's producing too much for current level of sales. 4. Capital efficiency. Capital efficiency and solvency. Capital efficiency and solvency are of interest to lenders and investors. Interest to lenders, those who have provided a capital or borrowed capital to the business, and those person who provides the capital for the business. In this component include 2 points. First, return on equity. Return on equity is calculated as per net income divided by equity shareholders or shareholders fund. Here net income means net profit available for equity shareholders divided by equity shareholders fund. This represents the return investors are generating from business. How much returns are generated from the business is determined by this ratio, return on equity. Second one is debt to equity ratio or component, debt divided by equity. The definition of debt and equity can vary, but generally these indicate how much leverage using to operate in your business. Leverage should not exceed what's reasonable for business. Leverage is not exceeds the reasonable business. It means debt equity ratio, debt to equity ratio or debt to equity component is indicate how much leverage is using in the business or concern. Fifth component, liquidity. Liquidity analysis address ability to generate sufficient cash to cover cash expenses in the business organization. No amount of revenue growth or profit can compensate for poor liquidity. It means liquidity generates the cash for payment of cash expenses in the concern. In liquidity component, there are also two parts. First point, current ratio. Current ratio is calculated as per the formula current assets divided by current liabilities. This measures ability to pay off short-term obligation from cash and other current assets. A value less than 1 means company does not have sufficient liquidity resources to do this. It means that if the current ratio is below than 1, then the company's liquidity position is not good. A ratio above 2 is best. It means that if your current asset is 2 rupees, then your current liability is 1 rupees. You have to easily set up this liability while selling the current assets or while collecting the money of current assets. Last point, interest coverage. Earning before interest tax divided by interest expenses. This measures ability to pay interest expenses from the cash generated by the business organization. A value is not less than 1.5 is cause for concern to lenders. It means that sorry It means that interest coverage ratio calculated earning before interest tax divided by interest expenses. This ratio express the ability to pay off interest expenses from cash generated in the business organization. The value of interest coverage is not below 1.5% is cause for concern to lender. Lender means borrowed those who have lent money in the business organization. Okay, in our today's lecture we are start our second unit, financial statement analysis. In this unit today we are study the meaning and components of financial statement analysis. In our next video or in our next lecture we are studied the tools and techniques of financial statement analysis. Okay, thank you very much.